Good day traders, Stacey Burke from Stacey Burke Trading. A short quick video on why you should study this chart. This is Tuesday, June 14th gold chart, 1 minute chart. And we'll just quickly go back and look at the bigger picture. We had the peak formation on Monday breakdown. We had 3 pushes into the high. We talked about breakout traders being trapped at the high of the month on a breakout gap. And I've been really reinforcing the concepts of building your playbook and trade setups. Now, for some traders, these are going to become just unconscious competence, day 1, day 2, day 3, all of that sort of scenario. But the reason why I wanted to go over this chart on gold is because of a explosive trade setup this morning in Asia. Now, when we come back to the beginning of the day on Tuesday, day 2, the market right on the open broke through the previous day's low. Big pin reversal that came back inside of the previous Monday's low. This is the low of the month currently. So we had a market that took out the high of the month, broke down and took out the low of the month. We talked about this Friday. CPI took out the low of the month, went straight up to the high of the month for 500 pips from top to bottom, came straight down on Monday, 500 pips from top to bottom, inside of peak formations from previous months on the daily chart. So again, coming back to understanding the thesis behind your trade setup so that when you get into the market, you actually know why you should be able to stay in that trade with your stop in place and feel confident that you've executed your setup properly and that your position, if wrong, will be stopped out, and if right, will hit your profit target. Something I learned from Brent Penfold was he would place his trade into the market and a profit target and leave it there and would not adjust his stop to break even or anything else. He was either going to get stopped out with a loss, or he was going to have profit. Now, several traders have asked me questions that I've answered in a lot of the videos multiple times about trade management, and on certain trades, 50 pip moves, scalps, whatnot. In many cases, there isn't really a lot of time, but when the market accelerates away through a low or high level, I've talked about level 1, level 2, level 3, we're going to go through that. But once it clears a level, and that can be a quarter level, 25 pips, depends on the instrument, because the box sizes will vary depending on the instrument and the range of movement. So if the market goes up 150 pips, and if it's 157, I don't sit there and go 157 divided by 3. It's 350 pip boxes. If it goes up 75, or if it goes up 67 or 82, that's 3 levels of rise. Now, I just want to focus on this chart because there's a couple things to understand about what happened and what transpired yesterday as well as into the Asian session today. So the market in Asia goes up. So again, traders are triggered short on the break of that monthly low. So understand the psychology of that. Traders will go to the 15-minute chart into the close of the session. Now go back, review the videos. Just in the last few videos, I've talked about understanding the significance of the 3-hour high and low. That can give you information heading into the new day, into the new session. We have a market that closes with equal lows, and right on the open, gold closes for 1 hour in between opening and closing. It vertically goes through and reverses. And what that tells you is 2 things. Number 1, the low was not in place yet. So the low of the day, although that is the low of the previous day, the low was still in process of being put in place. Hopefully that makes sense. The second thing to understand is that we now know that shorts, other time frame traders, are in the market. So I've talked about nobody gets a free lunch. What that means is that even if you're in the right direction, they might put some pain into you if you're in a, quote, trend trade, or you trade with the trend. They're going to come back into you. Or if you chase a candle Doesn't matter what time frame you're on. People keep saying, can you review this in the 1 hour time frame or the 5-minute time frame? It's all the same. If you have a level, the level is the level, regardless if this is the low. Okay, it doesn't matter if I use an hourly chart, a 1 minute chart, a 5-minute chart, or a 30-minute chart. That's the low. You have to think in some simple terms. Now, this was a breakout of the previous day's low. So we have shorts triggered at the previous day's low, which means they haven't had any pain put into them, right? So they were in the move towards the end of the session. They've had no pain. So there's breakout traders short. They may have had a stop at the high of the day and then moved it down to the lower swing high, which again comes back to our 3-hour high low. The U.S. made a new lower high later in the session. That, to me, becomes the new high of the day. But I also look at this and I say to myself, they're getting people to sell down low. So I talk about letting the day evolve. So the first thing I'm going to look at with this is Asia. We have a consolidation in the Asian session. It breaks out of that consolidation and heads up towards the breakout traders of the previous day. So in my mind, Asia breaks out of a consolidation at the low of the previous day. That's level 1. We are now in level 2 as the Asian session continues to auction higher. We go into the breakout traders from Monday's low, and that market continues to go higher. That's now, to me, pulls back, makes a lower high into our gap time. So if this will make it easier for traders, we'll put the 12 candle window on there to make things a little simpler. This is our first level that the market breaks out of. That's the consolidation from the reversal. Now you can draw your level down here. It doesn't matter. It really doesn't matter as long as you can distinguish where the consolidation is, and that's level 1. The market is making new highs. I'm not trying to short that. The market's going up. I'm not even at the screen. There was no setup there for me. The market's going higher. So look at the difference. Start to study price action when the market is establishing a range, or if it's order flow building back into a trading range. At the end of the 3-hour window, we have a new high. And it drops down. That's level 2. Why? Because we have a market that broke out of a consolidation, auctioned higher, came down and made a high, and auctioned lower, and then proceeded to go higher. Now we're into level 3, but we also have 25, 25, and 25. The market is made 3 levels of rise. So pay attention. We see higher lows. They're getting people, if they're chasing the trend now, to be buying on the 3rd level. But we have no indication of this market reversing. So as I mentioned to some traders yesterday, the time of day is what's critical whenever I get into a new session. Not only understanding the equity hour, so London, New York, 9:30 New York, 3 to 4 a.m. for London. I know some people say it's 3:30, I don't care. I'm just looking for that middle hour. And what I'm looking for is, has the first hour already gave me a trade setup? So I talked briefly yesterday. There's a difference between 3 levels in the gap for a vertical stop hunt on the open versus 3 levels evolving over the sessions, Asia into London. Again, coming back on day 2, right? Day 1 down. It's day 1 down. Okay. There's my high. That's my high bull. And we're moving up towards that with 3 levels of rise. When we zoom in closer, we can see on that lower high structure, there's an M formation, which tells me maybe double zeros, based on the timing of everything, may be where we get our reversal type of setup, if that setup shows. Level 1, level 2, and we're going higher now into the open of the Europe-London 12 candle window. The market continues to auction higher into the London open. So again, you'll notice we have higher lows, but we don't have any sign of a reversal, break in structure, double top, peak formation, whatever. We have nothing yet. We have a market that's making new highs. We have a pin high. And what do I always say about the pin? Draw a line across, because the pin could be the high up near my peak formation lower US session high, which is my new high of the day. That pin, though, what I want to see is if they go outside of that pin, if that pin is my high and they lock it in. So people keep saying, how do you know the high of the day is locked in? Is it a certain amount of pips and everything else? Go print your charts off and study the price action so that you know when the high is locked in. Now, I'm going to emphasize the clock, because people ignore the clock. They think, oh, London's open now. That's timing. No. The rotation of time gives you feedback as to how the pattern is evolving and when it could complete. So I have a peak formation that prints. Now we have a high of day that's taken out a higher low. A peak formation at our level that we marked off from the US session lower high. It comes down to our higher low, okay, breaks structure on the inside, pulls back immediately. Now you've heard me mention this in other videos. 30 to 45 minutes. No, in the first hour we did not have a high in place. Second hour, I'm looking for a high and a low to be in place in that 30 to 45 minute bracket. But also conceptually now, we have a market that's been going higher. What we want to see is a market that's gone higher and goes into consolidation on the third level and traps volume. So if the second hour is putting the high and the low in place, I'm already thinking it's a third hour trade setup. Think about time of everything. We're not just trying to get up here and sell this. So the market locks in the high, breaks structure, traps. So we have a low now in place in that London hour. They break structure and trigger the lows. So think about what's happened there. We have shorts now who have just sold the breakout at the low of that range. We got shorts trapped. We have breakout traders trapped at the high of the London Open. And we have shorts trapped. Make a high, make a low, pull it back inside, and then move the market. Repeat that to yourself. That is the same as the 3-day setup, the 3-week setup. Now, I'm just going to make a comment as well. A trader mentioned to me, can you go over all the major pairs? Because they were all different types of 3-day setups. That is your opportunity to build your playbook. So, for example, I will take the U.S. crosses. They will all be potentially maybe similar. U.S. yen, U.S. Swiss, U.S. CAD. They'll be 3-day setups. They might be in, like the Canadian dollar was a buy low. The other pairs, they're going to be different, but that's the variations that you need to study for your 3-day setups. You should be able to look at a chart and go, I can see that setup evolving now for a short trade or a long trade. They've moved it down. They made a high, they made a low. They're pulling it at its side, but it's trading back into the low for a long trade. Do you notice that the high in this particular situation, they're trading up into the high for a reason. They're jamming traders up into the high. They're getting them to chase it long into the high. So, break structure, they lock it in. Now we're into first 15-minute candle. 1, 2, 3 engulfment. And what do we see? A pin inside. First pin, first hour, they've locked in the high. Second hour, they've made a pin, they're locking in the high. So you can time this with 15-minute rotations, or you can get in. You can get in anywhere. And your stop still sits right here. That's your stop loss. The difference of timing is only how long you're going to sit in this trade before it goes. That's all. If that's your stop right here, and you sold it, let's say you sold it at the high, as some traders did. Let's say you sold it right here, and you went to break even. Do you understand what they're doing here? They're shaking you out of a winning trade. If your thesis is that you've sold this at the high, and you're targeting at a minimum the lows of the session and potentially the lows of Asia, where those first level broke out of, whether it takes 15 minutes because you sold it over here, or it takes an hour and a half, they're both right, except that they shake you out by trading back inside of the high before it shifts away for 50 plus pips. So understand, if you have a thesis and you're getting in and you're risking X amount on the trade, whether you sit there for an hour and a half or 20 minutes, your risk is still the same. You go to break even and get stopped out, but the market actually hasn't gone anywhere out of the third level. So understand that. That's what shakes traders out of winning trades. Now, coming back to today's trade. The market, a couple things. We'll go and look at the close. So the Asian session, we'll go back to square one. Our 3-hour window breaks. We get a lower high and a lower low. That lower high now is my new high of the day. Now, we're on day 3 at the low of the month. This was day 1 at the high of the month. I talked about trap volume up high. When we look for trap volume down low, it's the same thing. We're at the low of the week, the low of the month, the low of the day. They've got traders selling down low. This is all order flow, possibly for a vertical move. The market went into consolidation. That is not a pump and dump close. That is a consolidation with an ascending triangle forming. It breaks structure in that first hour. Breaks structure in that first hour. Now, if we go back and look at our pin, the pin from the previous day is right there. Have they locked in the low of the day? I don't know. I think so. I'm going to let this trade and see what happens. It breaks out, pulls back. There's our high. There's our low. The same process applies. In this particular case, they've made a new high. They've made a low in the first hour. They've gone into consolidation. Down low. It breaks out. In the second 15-minute candle, it starts to go. Third 15-minute candle, it's going. I'm in the trade. This trade, I should be able to put my stop in place and walk away and go to break even. No, I just leave it. Why? Because I'm confident I have my risk controlled. I have my stop in place. There's nothing that I can do by managing this trade other than stuff it up. It should go, and it should go quickly. So me going to break even, what that does in a trade like this, if it was auctioning, or if after 30 minutes it's 15 minutes, if I'm not in profit, then I'd be concerned. But me, there's nothing to manage here. All I can do is let the trade do what it's going to do. I have a thesis, it's working, let the trade out. Most traders will destroy a winning trade by moving to break even too soon or trailing it. They know that there's algos that will pin down into a trailing stop. Whatever that may be. You have to have that as part of your trade management plan. 90% of the time, I don't adjust my stop to break even unless the market goes vertical. What that means is if I'm in a longer time frame trade, high day, low day, or a session scalp that goes vertical and breaks out of a level trade. So this is level 1. We could say this is level 1 in this particular trade. Once it's cleared that quarter level, I should be able to go to break even, if that makes sense. So the difference when we look back at the London trade, we're on the third level. Okay. The market, this trade out is a 25 pip scalp if they scalped it from double zeros. and they've gone to break even, or they've taken the 25 pips off depending on where they got filled. But that break in structure is what triggers shorts into the market. That's different than the market coiled and ready to explode out. So market breaks out of the quarter after the consolidation. If you've sold up in this upper level, you should be able to go to break even once it clears that level. They're always going to reach back, but if you're confident in the trade itself, going to break even can be a costly decision. Let the trade play out. If you've managed your risk accordingly, and when I get into a trade, I accept, as Brent Penfold taught me, I write that amount down. I know how much I'm going to lose on the trade. I know how much my max loss should be on any trade, and I'm prepared to get out, whether the stop is in there or I manually exit before. If it negates my thesis in that trade setup, I get out. But there's nothing you can do. The trade is either right or wrong, or it's not a trade setup at all. So you have one of three things to do. Let the trade play out, get out of the trade, or take the loss on the trade. So hopefully you got value from today's video, traders. Again, the importance of building your playbook. I posted several screenshots of different day 1, day 2, day 3 type setups. There are day 2 reversal trades in a trend. There are day 2 trades with the trend. Again, have a thesis, look for the best trade setups, keep it simple. We're in some market environments that could potentially cause traders to make some costly mistakes. Keep it simple, focus on the best trade setups, and may the markets go with you.